Good afternoon, ladies and gentlemen. Welcome to Liberty Call for Thursday, May 12th, 2022. Hope everybody's having a great day out there. It's beautiful here in Colorado. It's 60-something degrees out here. Let me see. 64. Lots of sun. A little bit of a cool breeze. So hope everyone else is enjoying their Thursday out there in the interwebs. Noticed I trimmed up the old beard here. I don't look like a Viking anymore. So it'll grow back. Don't worry, guys. All right. Back and forth day in the markets. Really not real pretty, unfortunately. So, did try to get into the green a little bit early in the morning and made a nice rally at the end of the day, but was all in all pretty ugly. So let's go ahead and jump in and see how the indexes did today. The Dow Jones finished down 0.33% at 31,730. S&P 500 down 0.13 at 3930. The NASDAQ finished barely up at 0.06 above the flat line at 11,370. Small caps are up almost 70 basis points. The VIX receded today 2.43%. It's currently sitting at 3177. Looks like the other exchanges here in the Americas were kind of mixed. Canada was down 0.7. Brazil was up 1.25. Mexico was flat at up 0.07. Moving over to the European markets, I see just a sea of red. Germany was down 0.64. The UK was down 1.56. France was down 1.01. Euro stocks was down 0.94. Netherlands was down 1.11. Spain was down 1.35. Italy down 0.67. Switzerland down 0.41. Portugal down 2.33. Ooh, kind of ugly. Belgium was down 0.71. Austria down 1.58. And as we get over to Eastern Europe, Sweden down 0.2. Denmark down 0.41. Russian exchanges were mixed. The MOEX was down 3.74, while the RTSI was up 1.43. Moving over to the Asian markets, Japan was down 1.77, Australia down 1.75, New Zealand down 2.07. Over in China, the Shanghai was down 0.12, the SESE component down 0.13, the China A50 down 0.58, the DJ Shanghai down 0.18, the Hang Seng down 2.24, and the Taiwan weighted down 2.43. So overall, looks like the Asian and European markets were mostly, if not all down, kind of mixed here in the Americas. Not quite as bad here. So, yeah, let me bring up today's chart. Here's the Dow. You can see we opened up below the market. We started out down about what was that? About 300 points. Got up above the flat line in the 11 o'clock Eastern hour. And then from that point forward was just a down day. At its worst, we were down about 573 points on the Dow. And like I said, we finished up just under 100 down. So about 1/3%. The NASDAQ chart looks fairly similar. S&P 500 chart very similar also. The Dow Utilities was pretty much in the red all day. And the Dow Transports did finish in the green, but it was a very similar chart. Right. So, nothing too big to get too freaked out over. It's just what's going to happen when you have this much, extra cash in the economy and all this inflation. It's going to take a while for things to normalize again. So, all right, let's go ahead and dive into today's market recap. S&P 500 slips in wild trading as intraday bounce fades. Right. It's written by Yassine Ibrahim from investing.com. The S&P 500 fell Thursday as dip buying in the broader market ran out of steam amid ongoing fears of the Federal Reserve's plan to curb inflation could derail the economy. Really shocking. Tech failed to build on intraday dip buying as fears that elevated inflation will keep the Federal Reserve on a hawkish rate hike path, continuing to weigh on sentiment. Apple, Microsoft, Alphabet led the decline in big tech. Semiconductor stocks were also a big drag on the sector, paced by more than 3% fall in AMD. Producer price index for final demand increased 0.5% last month, in line with economist forecasts, and rose 11% for the 12 months through November, exceeding expectations for a 10.7% increase. Quote, nothing in yesterday's or today's report suggests the committee will deviate from the implied increase of 50 basis points on June 15th, although some are beginning to reconsider the possibility of a 75 basis point increase, Stifel said in a note. Financials also participated in the broader market sell-off under pressure from banking stocks as Treasury yields continue to lose ground on jitters about global growth outlook. Signature Bank, Citigroup, and Synchrony Financial were among the biggest decliners, with the latter down more than 8%. Wolf Research downgraded Synchrony Financial to underperform from peer perform, citing a deteriorating credit outlook. Energy stocks fell more than 2% as investors had to contend with wild swings in oil prices as investors continue to weigh up the risk of weaker demand backdrop against potential supply shortages. The earnings front, meanwhile, served up mixed quarterly results. WeWork narrowed its losses in the first quarter as a rebound in demand for office space following the pandemic-induced slump sent its shares more than 7% higher. Walt Disney, meanwhile, reported quarterly results that missed both top and bottom lines, but streaming was a bright spot for the company as it topped 200 million subscribers. The stock was down more than 2%. Beyond Meat fell more than 4% after reported a wider loss than expected as rising costs dented margins. Who would eat that crap? I mean, when you got real cows and steaks, I mean, why would you eat something that's completely fake? Quote, with increasing competitive pressures, challenges in scaling the business, and intermediate term capital needs, we believe investors should stay on the sidelines, Oppenheimer said in a note. Rivian Automotive jumped more than 16% despite reporting weaker than expected quarterly results. Quote, this quarter for Rivian was not without issues, but it does finally appear that Rivian is on the right track with strong demand and supply chain that should produce 25,000 deliveries this year, reaffirming its guidance, Wedbush said in a note. The latest dip in markets has many debating whether or not whether stocks are close to reaching a bottom. Some on Wall Street have earmarked the 30-month moving average near 3,800 for the S&P 500 as the level that could attract dip buyers, but remain wary of suggesting that a bottom is close. Quote, we still believe the U.S. equity markets are closing in on a significant low for the year, but again, this process may take more time and see more damage before more damage done before that materializes, Janie Montgomery Scott said. So, yeah, not the best, unfortunately. Let's see here. I do find it humorous that so many of the prognosticators are continuing to try to call out the bottom or call out this is the end of inflation, or inflation is slowing down, when history tells us that when you go through a major downturn, you're probably going to lose close to about 50% of your value if you're holding on to those securities. So you have two choices: either ride it out and dollar cost average, coming off the bottom, or make a executive decision to reduce your exposure in equities and sit on the cash. But then your cash is subject to the whims of inflation. So it is kind of a damned if you do, damned if you don't. And there are also some hedges you could put in place, but that's for more your advanced trader. All right. U.S. labor market still tightening. Producer price gains moderate. It's written by Lucia Mutakani from Reuters. The number of Americans filing new claims for unemployment benefits unexpectedly rose last week, touching the highest level in 3 months, but there's no material shift in labor market conditions amid strong demand for workers. The report from the Labor Department on Thursday also showed the number of people on state unemployment rolls was the smallest in more than 52 years at the end of April. Companies scrambling to fill record job openings are boosting wages, contributing to keeping inflation elevated. Quote, there is no change in the underlying message of a very tight labor market, and employers are willing to lay off existing workers in the face of extreme labor scarcity, said Conrad de Quatros, senior economic advisor at Breen Capital. Initial claims for state unemployment benefits increased 1,000 to a seasonally adjusted 203,000 for the week ending May 7th, the highest level since mid-February. Data for the previous week was revised to show 2,000 more applicants received than previously estimated. Economists polled by Reuters had forecast 195,000 applicants for the latest week. Claims have been largely treading water since hitting more than a 53-year low of 166,000 in March. Economists blamed the second straight weekly increase on residual volatility in the data around moving holidays like Easter, Passover, and school spring breaks. Big rises in filings in California, Virginia, and Illinois offset a decline of 9,811 in New York. There were a record 11.5 million job openings as of the last day of March, and non-farm payrolls rose by 428,000 in April. The 12th straight month of employment gains in excess of 400,000. Claims have dropped from an all-time high of 6.137 million in early April of 2020. The number of people receiving benefits after an initial week of aid dropped 44,000 to 1.343 million during the week that ended April 30th. That was the lowest level for the so-called continuing claims since January of 1970. Stocks on Wall Street were trading mixed, while the dollar rose again against a basket of currencies. U.S. Treasury prices climbed. In another report on Thursday, the Labor Department said the producer price index final demand rose 0.5% in April as gains in energy products slowed. That marked a sharp deceleration from March when the PPI surged 1.6%. April's increase was in line with economists' expectations. Energy prices rose 1.7% after shooting up 6.4% in March. Food prices climbed 1.5%. As a result, goods prices advanced 1.3% after jumping 2.4% in March. The cost of services was unchanged after vaulting 1.2% in March, but energy prices have since accelerated with demand, while demand is reverting back to services from goods, which suggests the monthly PPI will pick up in May. In the 12 months through April, the PPI increased 11%. After accelerating 11.5% in March. Quote, while inflation still looks strong, while inflation is still looking strong, there are some signs that we may have moved past peak rates, end quote, said Daniel Silver, an economist at JP Morgan. The slowdown in monthly producer price gains followed a similar trend in consumer prices last month. Data on Wednesday showed that consumer prices logged their smallest rise in 8 months in April. The annual increase in consumer prices also slowed for the first time since last August. Producer prices, excluding food, energy, and trade services, climbed 0.6% in April after rising 0.9% in March. In the 12 months through April, the so-called core PPI rose 6.9% after accelerating 7.1% in March. The rise in underlying producer prices followed a similar trend with core CPI. But components of the core personal consumption expenditures price index, one of the key inflation measures closely watched by Fed officials, were weak last month. Portfolio management fees dropped for a third straight month because of the stock market sell-off. The cost of hospital inpatient care and doctor services fell due to a reduction in Medicare payments to providers starting in April. Used motor vehicle prices were flat, while airline fares rose. They did not match the record increase in the CPI report. Based on CPI and PPI data, economists are estimating that the core price index rose by about 0.2% in April after advancing 0.3% for 2 straight months. That would slow the year-on-year increase to 4.7% from 5.2% in March. Quote, still modestly softer PCE inflation is unlikely to alter the near-term path of Fed policy, and we continue to expect 50 basis point rate hikes at each of the next 3 meetings, end quote, said Veronica Clark, an economist at Citigroup. So things are still getting more expensive. It does appear that they may be slowing down slightly, just a little bit, but we'll see what happens in the next 30 days. All right. On the mortgage front, average U.S. mortgage interest rates rises to 5.53%. Applications are up. This comes from Reuters. The average interest rate on the most popular U.S. home loan rose to its highest level since 2009 last week, and demand for mortgages jumped for a second straight week despite the rising costs. Mortgage Bankers Association data showed on Wednesday. The average contract rate on a 30-year fixed mortgage increased to 5.53% in the week ending May 6th from 5.36% a week earlier, so up about, 17 basis points. It has now risen 242 basis points from 12 months ago, which, for you non-financial people, that's 2.42%. the sharpest rise in decades as the U.S. Federal Reserve tightens financial conditions to try and dampen demand across the economy as it battles for 40-year high inflation rate. The housing market, flashing signs of overheating over the past 2 years, is seen as a particularly rate-sensitive sector, and Fed policymakers are keen to sap some of its current double-digit annual price growth. Whether they can cool the market as such as they hope remains to be seen, with price growth fueled by record low housing stock, unusually high household savings, and an extremely tight job market and increased worker mobility. Mortgage applications rose last week for the second week in a row. The MBA said its Purchase Composite Index, a measure of all mortgage loan applications for purchase of single-family home, increased 4.5% from a week earlier. However, this was still below levels seen just a month ago and almost 8% lower than the same week 1 year ago. So when we see the housing market really start to slow down, I think that'll be a good sign. Maybe not if you're in the housing or mortgage business, but it has to start somewhere. And I think that'll be a clear indicator that some of this inflation will begin to wane. All right. Next article, a Harvard economist says the economy looks bad right now, but a recession isn't a sure thing. It all depends on these two factors. Who wrote this? Tristan Bove. These days, the economy seems to be on pins and needles. Stocks are crashing, investors are jittery, and voices continue to murmur that recession is nearly upon us. Things look bad right now, but one economist is refusing to get drawn into worst-case scenario fears and says that two major factors indicate a recession is far from certain. In an interview on Wednesday with the Harvard Gazette's Jason Furman, a Harvard professor and former presidential economic advisor under Barack Obama, said current market volatility is an inevitable function of the Federal Reserve's policy to raise interest rates to combat U.S. inflation. Furman is unsurprised that the stock market is behaving so erratically right now and suggests it may have been unavoidable. Quote, one thing that runs through the entire economy is interest rates, end quote, he said. Quote, when interest rates go up, it becomes more attractive for investors to move their money into bonds and out of stocks, and that causes stocks to fall, end quote. President Biden has made it clear that a top domestic priority is to bring down the country's inflation rate, which is latest reading sat at 8.3%. To do so, the Federal Reserve has been progressively raising interest rates since March, a move that was bound to have some repercussions on the stock market. Furman said other factors such as COVID lockdowns in China affecting manufacturing have severely harmed stock indexes, especially the tech-savvy NASDAQ, but there's still only, quote, one story that runs through everything, and that's interest rates, end quote. But that doesn't mean that higher interest rates carry no risk at all for the economy. The Fed's attempt to engineer its way out of inflation could end up in one of two ways: a soft landing for the economy, wherein inflation subsides without a significant decline in economic activity, or a massive uptick in unemployment, or a hard landing, also known as an economic crash. Fortunately for the economy, two factors seem to be in favor of a soft landing outcome, according to Furman: consumer activity and gasoline prices. Hang on, I need a drink. All right, diving back in. Despite higher prices across the economy, consumer activity has remained strong this year, predominantly due to the large amount of U.S. amount of savings U.S. buyers amassed during the pandemic. Whether U.S. consumers are able to continue buying through the storm of inflation will be a key factor in a recession happening or not, according to Furman. Quote, I'm relatively unworried about a recession over the next year because consumer spending has continued to be very strong, and consumers have about $2.3 trillion in excess savings that they've accumulated during the pandemic that could still spend out over the next couple of years, end quote, Furman said. The idea that the strength of the U.S. Consumer may have the economy save the economy from a recession is founded on the country's low unemployment rate and large pandemic-era savings, and Furman is not alone in holding this view. Investment bank Goldman Sachs has found a similar silver lining, recently assuring investors that while the risk of a recession is rising, quote, the financial health of the private sector may ultimately determine whether policy tightening will tilt the economy into a downturn, end quote. Excuse me. But even if consumer spending does not stay high enough to stave off recession, Furman is seeing a major contributing factor to inflation beginning to stabilize: gasoline prices. Quote, if you want to ask how much inflation we will have going forward, you want to take out volatile things like oil prices and gasoline prices because they've already spiked really high and they're probably going to come down, Furman said. Thursday's national average for gas was $4.41, over $1 higher than a year ago. But the world's producers have been working hard to pump more supply to cool down prices, including Biden's plan to release a record 1 million barrels of oil a day from the country's strategic reserve. As we can tell, that hasn't done a whole lot to bring down the price. Quote, the good news is that part of inflation is likely to level off or come down, Furman said, referring to the impact of high gas prices on inflation. Quote, even if overall inflation is high, the part of inflation that people most notice should be getting better. There's very little reason for them to keep rising the way they have, end quote. So he, in his view, is that gasoline prices should start to recede sometime soon, which will then, again, do that trickle down effect. You remember how we talked about how the influx of cash 2 summers ago caused inflation a year later, and then we're still seeing it today, and that that's what led to the price of oil and gas going up. Also, with the reduced amount of pumping that was going on and production. So, all right, one last article here. Again, talking about the Fed. Fed should hike to 5% or higher to curb inflation, Dudley says. Written by Alistair Bull. Former Federal Reserve Bank of New York President Bill Dudley said the U.S. central bank should stop, quote, sugarcoating its message on how high interest rates need to go and how much pain that will cause to get inflation under control. Quote, I think it's 4 to 5% or higher, Dudley said in an interview with Bloomberg Surveillance on Wednesday, on how high the Fed should raise interest rates to cool price pressures. Quote, I was 3 to 4% maybe 6 months ago. Now I'm 4 to 5%. And it wouldn't shock me if I'm 5 to 6 a few months from now, Dudley said, who is a Bloomberg opinion columnist and senior advisor to Bloomberg Economics. Read Dudley's column. The Fed needs to get real about interest rates. Let's see here. Data released on earlier on Wednesday showed. Is there a link to this article? No, there's no link. Data released earlier on Wednesday showed the consumer prices rose more than expected in April, with the core gauge, which excludes food and energy, increasing 0.6% from a month earlier and 6.2% from April of 2021. The Fed raised rates by half a percentage point last week to a target of 0.75 to 1%. And Chair Jerome Powell signaled it would hike by a similar amounts at its next 2 meetings, while leaving the door open to doing more if needed. Officials say they think they can soft land the economy and avoid a recession or sharp rise in the jobless rate. But Dudley argued this message could do more harm than good. Quote, the Federal Reserve has got to tighten monetary policy sufficiently to slow the economy down and push the unemployment rate up. That's what's required. And I think the Federal Reserve should be more forthright about explaining that to the American public. Dudley said, quote, if you start to sugarcoat it, then financial conditions don't tighten as much, and you also run the risk that people will lose confidence in the Federal Reserve, end quote. Yeah, I think we've all lost confidence in the Federal Reserve at this point. So, these folks will do the least amount of work to try and make it look like they're doing something to try and make things better. But in the end, it seems all they do is make things worse. So, all right. Well, that's everything I had for today. Hopefully I didn't depress y'all too much with, we do have 2 different sides of articles. One Harvard economist thinks things are okay. The others thinks we should do a hell of a lot more to, right the ship. I'm with the latter. I think we should have probably raised rates probably starting last year. But hey, you gotta make things look good on the outside. It's like making a cake with horribly, with the insides that just taste terrible, but you put a delicious looking frosting and, decorate it, make it look real nice. But when you dig in, it's full of maggots. So anyways, all right. Well, hope you got something from this. If not, I'll try better tomorrow. I'll be back tomorrow with the weekly wrap up. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. All right. So everybody have a great evening. Bye-bye.